British America Tobacco announced that they're going to be paying out their dividends for 2024. That is the final dividends. And it's the dividend paying season. We have so many companies that are paying out dividends, from Stanchart to Stanbic to Coop to Safaricom. So today we are going to be analyzing their stock and see, is it worth still buying today, and how the numbers and calculations look like, especially if you are a beginner. It's quite interesting because last year in September, they paid out their interim dividend. That is the first dividend. And it was 5 shillings per share. Before I continue, this is one of the most expensive stocks in the NSE market. It ranges between 370. Most of the time, it's usually around 370 there, at least this year. It's around 360, 370, 380, can even go up to 400. So that's something to keep in mind. In as much as when you look at their dividend, you're like, whoa, that's big money. This was for September last year in 2024, the interim. They paid out 5 shillings for every share. Now, the one that they have announced that they are going to pay this June, to be specific, on 25th June, they're going to pay out 45 shillings for every share that you own. Imagine. It's a huge, I'll say it's fair. It's a fair number. The ex-dividend date. So you should own these shares by 26th May 2025 for you to earn this 45 shillings. So if you buy this stock on 27th, you're not going to make any money. You have to own this stock by 26th May. And they're going to pay out a month later, which is 25th June, and they announced in February. You can imagine, they've given us time to think about this stock and to trade. Anyway, I have checked the share price today, which is 28th March. The price was 371.25. What you have to note here is that this is not a specific price for that share. The price changes depending on the person who is buying and who is selling. There was a point in time today in the morning at around 9 a.m. the price was going for around 378. You can imagine. Then it went down to 370. There was a time it was 371.25. So I'm using this specific price of that share because, again, it's at a specific point in time. So let's look at how it's performing in terms of dividends. It usually has a good dividend yield. A good dividend yield measures the ratio at which, or rather, it measures the dividends that you've earned, the total dividends relative to the price of the share today. So when you're trying to look at a good dividend paying stock, this is what you should look at, the dividend yield. Yes, you can see that the dividend is high, but what about the price? So you have to do that comparison. When we add up the total dividends that they paid out, the 5 shillings that was paid out last year, and the 45 shillings that is going to be paid out in June, it's 50 shillings. That is the total dividend payout, assuming that you owned this stock by then. I've divided that with 371, the price for the share. It's 13.46, which is a good percentage because we have companies that have even 9%, 9.1%, 8%. So this is a good dividend paying company in the Nairobi Securities Exchange market, in the stock market. Now, assuming that you want to buy 1,000 shares, you've looked at it and you're like, Ivy, let me just buy this share so that I can enjoy this dividend. So you're thinking about it from the mindset of buying a dividend. 1,000 shares. It's expensive. Yeah. One share goes for 371.25, assuming that you bought this share from that person who was trading, was willing to trade it at this price. You buy 1,000 shares today, it's going to cost you 371,250 shillings. Yes. So if you had bought, let's say 100, the minimum shares, it will be, we remove the 0, you're going to pay 37,125, just the bare minimum. So anyway, we're going to add up the, the broker fee. Assuming that your broker is going to charge you 2.1%. It can even be 1.8%. Actually, I should have used 1.8%, but it's still okay. So it depends on what your stockbroker is going to charge you. You add that. This percentage is representative of the taxes and the broker fee. So it's just a one-off fee that I've used here. Before you say, IB, you did not include the statutory, the levy. It's actually the levy fee. So 2.1%, this is going to be an additional cost, 7,796. In total, it's going to cost you 300. So this is like 380 Gs to own 1,000 shares. Now, you've bought this with the aim of earning dividends. Here, I have assumed that you owned this stock last year in this calculation. So you've managed to receive the total dividend payout, the total dividend. That is, you received the 5 shillings round 1. You owned this stock by September. I think it was in September or October. You owned this, September. You owned this stock by September, so you received the 5 shillings, and now you still own the share, and you receive 45 shillings. So in total, you would have made 50. In total, you would have received 50 shillings for every share that you own. This is 50,000. We take away 5%. 5% is the dividend tax. So you remain with, this should not be a percentage. So you remain with 0.95 times the 50K that you've made. You would have made 47,500 so far if you owned this stock by then. But if you're buying it right now, taking this scenario into account, we just multiply. Allow me to remove this. We just multiply the 45 shillings that you're going to receive for the first time times the 1,000 shares, which is 45K that you're going to receive. Then we take away 5% of this. So you take away 5%, you can do the math. Now let me show you something that is important when you're buying a stock, especially when you're buying it from the point of view of earning dividends. Here, you're not a trader. You're not taking advantage of buying and selling. It depends on the type of person. But as somebody who is beginning, there's certain things to look out for when you are buying a stock. For example, I checked out how British America Tobacco have been performing for the last 1 year. And this is how their graph looks like. It's a fair representation of how the graph looks like. But what's interesting is that last year at a time like this, the price of the share was going for 14.5 shillings. I told you the price is high for this stock. That's how attractive it was, that somebody somewhere was willing to buy it at for 14.5 shillings. Right now, it's at 371 shillings there. So this is last year. This is today. You can see that the price is lower. So let me just do this. The graphs that we learned are now applying here. Now, if you bought this share last year, this is 28th March. I just checked when they were paying out dividends, like what could explain this behavior as to why the price went as high as 414. And around last year, in February, just like this year, they have a cycle, I've noticed. In February, they announced that they were going to pay out dividends, the same way that this year they've announced that they are going to pay out dividends. And they were going to pay out those dividends around May. I didn't check the dividend date, the ex-dividend date, but the fact that they had announced that they're going to pay out dividends is one of the things that attracts people to buy this stock. Think about it. They've announced that they're going to be paying out 45 shillings for every share that you own. Why would you not want to own this share? Immediately they've announced. Remember, with stocks, it's about demand and supply. It's about demand and supply and how much somebody is willing to pay for that stock. At this point in time, somebody was willing to pay for 14 to earn those dividends, but the graph went down eventually. So there was a high peak then. It went down. I don't have the specific month, but this one is today. My point is this. If you're going to buy a stock, buy earlier on. That is if you have the intention of earning dividends. Because now that they've announced this and the graph goes up to 414 again, assuming it can go up to 414 to 450, depends on demand and supply for that stock. Assuming it goes to 414. So you, who is a beginner investor, all you know, you've had Ivy talking about this dividend that is going to be paid out by BAT. You go ahead and buy this share when the price is this 414, assuming. But you've seen the graph has gone down. And the graph has never gone up since this 414. So whoever bought this share for sure, they lost if they sold this share at a certain point in time. Assuming that they sold it here, they realized, oh my goodness, the price is never going to go up. So let me just sell it quickly before the price goes down, before it gets here. Again, this is speculation. So this person lost here. Yes, they earned the dividend, which is 45 shillings, as long as they lost with an amount that is not more than the 45 shillings. Well, it's a fair deal. I don't know if you get what I'm saying. This guy bought it at 414, received these 45 shillings per share at around May, let's say here, decided to sell the stock when the price was here. That is just one scenario. That person lost because the price has never gone up. Nobody was willing to buy it at that point in time. But at least if they sold it, assuming that they bought it at 414, let me write it here. Assuming they bought it at 414 and they sold it at, let's say 400 shillings. Did it ever get to 400? Let me just use this. So here they lost 14 shillings because they didn't want to hold on to this share. Now I'm talking about trading, but at least they received 45. So 45 minus 14, that's 31. So their actual gain was around 31 because the gain, 45 shillings, was offset by the loss of 14 shillings. So this one is fair enough. But if this person sold it when the price was less than 45 shillings, so that is 414 minus 45, they managed to sell their share when the price was, this one is 3, this one is 7, this one is, this is 4. Assuming that they sold this, they held on to this stock until the price was 374. When they gave up and they sold it, there is no benefit that they gained. Yes, they earned the dividend, but the loss from selling it was offset later. Either way, if this person is still holding on to this share and they want to sell it, they're still going to lose because now the price is 370. The only time that they might not really fail, but it's just going to be evened out, is that they have to hold on to this stock until the price goes up to 414, if it ever goes there. In short, be an active investor. Look out for the graph. The graph is usually there on the stockbroker. Once you have access to their platform, just be on the lookout. Look at the graph and also be an active investor. See what's happening around with regard to the company. Is the company making profits? Is the company making losses? Things like those. Thank you for watching this video. Check out my other videos. There's one I've done for Safaricom shares. I analyzed Safaricom shares. I analyzed Stanbic. The previous one before this, I analyzed KCB. You can check that as well. See you in the next video.